Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for January 25th of 2021. Please see a disclaimer for important information. In our commentary this week, we're really going to focus on the investment markets, maybe a little less on economics perhaps, but we'll have some side notes. We did have some data over the last week. Want to get caught up as we get closer to the end of the first month of 2021, where we can kind of talk about some of the things that are kind of shaping up for us right now. And we are in the midst, frankly, of the busiest week of the earnings reporting season for the S&P 500. In fact, we have, I believe, almost a third of the index reporting this week, if not more. So it's going to be a very active week. And I think, we could have some implicit drivers of the market based on commentary that comes out of some of these earnings calls. I think it's, less important to kind of note what the earnings themselves are, because we know that there's been some noise. So certainly the year-over-year comparisons for a lot of companies are going to be a little bit different due to the pandemic, but I think what's really going to be critical here is comments from management and what they say and how they feel about their environment. And we know from CEO surveys earlier in the year that CEOs by and large feel a lot better than perhaps even consumers do. CEOs are inherently bullish, I guess, on their prospects, but I think to the degree that we hear about companies making additional investments in infrastructure, investments in growth initiatives, and things like that, it will be key, and we'll be looking for that. But kind of get caught up with the issues of the week. The Dow Jones for the week was up 0.6%. The S&P 500 was up 1.9%. NASDAQ was up 4.2 as we saw a little bit of leadership kind of a leadership shift. We'd seen cyclical names kind of come to the fore, financials be a leading group there. But for several weeks we saw those cyclicals kind of take the lead from technology stocks, and it's clear in that data comparing the S&P return to the NASDAQ over the last week that technology has reasserted itself, at least for the time being. And that really kind of represented a respite from the shift towards small cap and cyclical stocks. And in fact, that NASDAQ number was the best weekly return since early November. So year to date, the S&P is up 2.3, the Dow Jones is up 1.3, and the NASDAQ is up 5.1. If you look across the seas, the MSCI Europe index was up about 2% for the year and for the month, frankly. And the EFA index, another international proxy, was up about 2.4%. And emerging markets are up 8%. EM has exhibited really strong performance here in this last month, and we do expect more outperformance from the emerging market area. Volatility itself is a little bit down. We think that's going to pick up, but the VIX itself is about 22. We don't really talk about that much, but it's down about 4%. For the month, but in 2020 volatility was up about 66%. So if you look at fixed income in the credit markets, the Barclays aggregate index was down about 0.75 percentage point month to date. High yield is still positive, and so are leveraged loans. So what that means is we're getting more spread tightening, which is just phenomenal at this point of the cycle, that you typically just don't see those spreads this tight. It just signifies an asset bubble on several fronts. Now, conversely, on the commodity side, we've had some metals that have done really, really well, industrial metals, copper, so on and so forth. In our charts of the week, we had several several of those commodities. Cotton prices are up, lumber prices are up, but crude prices for the year are up about 7.7%, and last year they were down about 21%. So we've had good response out of crude this year. Crude prices, WTI is about $52.27 as of the end of last week. So strong performance there. Natural gas has been a little bit weaker. And gold has been off about 2% for the year. It's about 1856-ish on that, and it's been as high as 1900. We've seen a little bit of rotation out of gold as people have kind of maybe looked at Bitcoin a little bit, and usually a risk-on trade doesn't tend to favor gold as much, but the other thing that I think is probably just as prominent in the shift in gold here has been just a latent strength in the dollar. Ironically, the dollar is up about 33 basis points for the year. It was down about 7% last year, and I do think the dollar index is going to reverse, and it's going to be we're going to have more decline there. A 10-year Treasury off maybe a little bit for the week. It was 1.09%, and so last year it was down over 100 basis points, or 1 full percentage point. But so let's see, we've kind of talked about just the transcendental economic data. Housing starts beat expectations with a 5.8% monthly gain in December, and that to 1.67 million units, and that's the highest number that we've seen since 2006. Building permits continue to be strong, hitting a cycle high of 1.7 million units. We did have a little bit of progress in initial claims that were down to 900,000, but it still remains fairly elevated. And obviously, we've got a lot of pandemic-related lockdowns and things like that that will continue to influence that initial unemployment claims number higher. And then we'll get GDP coming up on the 28th. We are expecting kind of basically a quarter-over-quarter gain of about 4.4%, fairly modest. This is for the fourth quarter, so we'll have to see what the read-through there is. But there's a chart in the Charts of the Week pack that shows that inventory levels are exceptionally low right now. And I think that's a source of potential economic strength as we trend into the first half of 2021, that inventory replenishment can have a huge impact on GDP. Looking at other things here, I mentioned earnings. So thus far, we've had 65 S&P 500 companies have reported. 86% of them have reported positive earnings surprises. 82% have reported positive revenue surprises. And then those surprises on earnings have surpassed estimates by more than 22%. And, with some sectors like financial are doing exceptionally well. Obviously, a steeper yield curve with higher longer-term rates are really a positive for them. But overall earnings reporting season really strong. As I said, this is going to be a big week for earnings reports. And we've had a really strong inflow into the equity market. In fact, we had a record $255 billion that's flowed into the equity market over the past 3 months. And we've had a lot of that drive into cyclical sectors. Obviously, financials and materials are in there as well. And this is all despite the pandemic, the elevated jobless claims, so on and so forth. Another positive economic read-through here is that we've had manufacturing and service sector purchasing manager indexes, or indices, I should say, PMIs. Those have exceeded expectations. So, we've had some really pretty decent data to go along with these earnings surprises. Obviously, these positive money flows into the market. There's still an awful lot of liquidity out there, where equity market is there is no alternative or TINA. As we look kind of into the equity market a little bit more, we're still in this post-recession recovery. It's kind of hard as it is to believe that we had a recession and it was exceptionally brief. We're in this, what I would say, kind of the tail end of the initial phase of it. And typically that lasts a little bit less than a year, and you get a really strong return of, you get this bounce back of, almost 50%. But we've had almost a 70% return, and it's not been quite a year yet. So, it kind of makes you think that we might be at the end of this initial phase of this post-recession recovery in our equity markets. And then you have kind of a period where the market settles in a little bit, and you tend to lose money over, a period of a few months as you get consolidation in the market. People are taking profits, and investors are turning over. You've got the speculators that are kind of giving way, so to speak, to more of the long-term investors. And then, then you get that kind of that second wave, if you will, after that period of consolidation, and then market goes back up. And so I just, looking at all of this data, and there's several charts and charts of the week this week that kind of give you a sense of kind of this froth that we're in right now, that, I feel really good about the long-term environment, but near term, we could have this consolidation period kind of, or phase kind of play itself out a little bit, where, we don't continue to see these strong gains in the equity market, and we see a little bit of settling out. But usually in that second wave, after you go through this consolidation, you get another 15 to 30%, which I think is really, it's in the offing for us. We just have to be patient. But we're clearly, seeing a lot of froth in the market. Let's see, we've got the Citigroup euphoria / panic index. A higher number, it represents euphoria, and that index itself is as high as it was, in fact, higher than it was in 2000, which was on the eve of the tech bubble, the beginning of the century. So, and we've got PE ratios that are outsized. S&P's trading at about 22.7 times next year's earnings. The 5-year average is about 17.8, and earnings for the fourth quarter right now, again, we're seeing all these reports come out now, expect to be about 7% lower on the heels of, just a couple of quarters ago, they were down like 32% year over year. But if you look at the market, we've got other valuation indicators, enterprise value to sales, that are basically as high as they've been in a long time. You've got, what's interesting, and Sandy Leeds indicates, makes a comment about this in some of his notes from the week. But what's interesting is last year, the S&P 500 was up 18.4%, and the NASDAQ was up 44%. But the FANG group, that concentration of technology stocks, that group was up 55%. And if you take the remaining 494 stocks in the index, they were only up about 4%. So the idea is that we've had, even though we had a lot of strong response overall and more breadth in the recovery in the stock market over the latter 4 months of the year, for the year as a whole, technology has really been the driver, and the rest of the index is, for the most part, kind of plotted along here. But so, they're reasons to be, a little bit less optimistic. There are reasons to be optimistic. Um, and, yeah, typically, when you get a fairly strong, kind of recovery, you get follow-on returns over a multi-year period that are positive. So that's something to look forward to. If we get past this little consolidation phase, we've got a lot of stimulus. We're getting more stimulus. There's confidence that comes from that. And the investor sector, which is kind of rides side saddle with consumer sentiment. And so we do think that, stimulus that we're going to see eventually is going to be driven for, infrastructure, highway bridges, things like that. Overall stimulus is going to be, I think, pretty powerful over the next year. And probably, the higher taxes that we know are coming are probably not going to fully offset that. Although we do clearly see higher taxes. I don't think there's any doubt about that. As we look at taxes, a couple of comments here that, we're probably looking at a corporate tax rate going from 21 to 28%, although, basically cutting the difference between where they were. And interestingly enough, the effective tax rate for S&P 500 companies was 24.4% in 2017, and that dropped after the tax law went into effect down to about 17.7%. So, I think, as much as I guess companies won't like it, I do think there's obviously going to be an impact to net earnings per share, but I don't see a cataclysmic impact on the stock market per se, but clearly the market's not going to like that, but I think everybody expects that to play out. And then we could also see clearly some increased taxation on capital gains and dividends for kind of the uber rich, if you will. That's just a comment there. We'll know more. We're getting through all of these executive orders and some of these initial things, and then but I do think that Biden administration is going to want to circle back to some of these other more kind of long-term pressing tax issues. But let's see. Yeah, so we've got stimulus. I talked about stimulus. We've got a lot of activity in the equity markets. We've got more equity supply. Since we didn't have as much share repurchase activity last year and stock buybacks because companies were conserving cash. And we got a lot of demand for assets out there. You clearly see that, and all you have to do is look at Bitcoin for that. So I think the liquidity coupled with the strong balance sheets for the publicly traded firms and a strong kind of consumer or individual investor interest will kind of help set the stage for more equity demand and more upward bias in the index. So on fixed income, we know we've had a little bit of an increase. I've already said the spread on investment grade bonds rather, is about 93 basis points. That's incredible. We had a record 1.7 trillion in new bond sales last year, which at the corporate level is driving pretty high debt levels, but at the same time, the interest cost on that debt is very, very low. And we've got junk bond yields at record lows. It's just, it's crazy. The CCC rated corporate bond index hit a record low of 6.42%, and this is just crazy uncanny, just a kind of symptom of this kind of blind faith in the economy to plow through whatever stands before it. Let's see. let's see. I don't think we want to talk about China this week. We heard that their economy perked up about 2.3% last year, and that was the only major world economy to actually have positive growth last year. So I do like the equity markets. I do like fixed income if you can stay ultra short. Earnings, I think, are going to be better than expected. I do worry a little bit that longer term earnings expectations, like in the third, fourth quarter of this year, maybe slightly into 2023, might be a little high. We are going to have to reckon with at some point this debt that we've got. We're asking private buyers to absorb essentially about $3 trillion in federal debt here because of this budget deficit and deficit spending. But, and over the long haul too, we're going to have to reckon with this whole modern monetary theory that kind of represents a belief that a country can print and spend at will. And history has proven that that doesn't work out real well over long periods of time. You tend to wind up with, devaluation of your currency as well as inflation. So right now the market's not considering that. Certainly legislators aren't considering that. And we don't have to worry about that right now. But that's something that, we get 5 to 7 years, probably more like 7 to 8 years down the road, we're really going to have to kind of wrestle with that. But I think the feedstock is in place, if you will, for a reasonable earnings year, not stellar. I think it's in place for a reasonable economic improvement over the course of the year, but not stellar. And I think that sets the stage for increased asset prices. And I think, what we're already seeing in producer prices in some cases, especially with these input commodity costs like lumber and cotton, that you could see consumer prices be impacted by that, and that we would get inflation. I think that, coupled with the fact that, I do think the dollar, which has been low, if it weakens further, it could drive more imported inflation, which could help provide more, tailwind behind this inflation story as we head into the end of the year. I don't see hyperinflation, but I see higher inflation, and I certainly do see an increase in 10-year Treasury yields, maybe moving up from, they're roughly 1.1% now to maybe 1.5% or so by the end of the year. Again, not cataclysmic, but still represents kind of an uncomfortable move if you have longer term fixed income investments. So bottom line is we're staying short on fixed income. We are recognizing this kind of shift in leadership in the equity markets. So we're adding more international, more small cap, maybe even a little value in there as well. We're maintaining a little bit of portfolio protection right now to kind of acknowledge the fact that we might be in for a little bit of turbulence here, but we are clearly positioned for the long term, in which we do believe we will benefit. So next week we'll have the benefit of more earnings reports, more visibility, more management comments, and such. We'll report those back accordingly, and that will basically do it for the commentary this week. Hope you've enjoyed these comments this week, and hope you have a wonderful week, safe week. Feel free to reach out to us at the information provided, and we will talk to you again soon.